What if I told you there's a simple price pattern that can give you a clear entry, a defined stop, a realistic one-to-one target, and when you understand why it works, you'll start seeing it on almost every trading session. It's called a fair value gap. And no, I'm not saying every fair value gap is going to be a winning trade, but when you understand where they form, what they're telling you about price, and how to use them in the right context, they can become one of the simplest and most powerful tools in your trading. So in this video, I'm going to break down exactly what a fair value gap is, why price tends to react to them, and most importantly, how you can actually use them to build a high probability trading setup. Let's start with the concept. Fair value gaps, how they actually work. If you spend any amount of time studying price action, you're going to notice something interesting. Price doesn't move through the market evenly. There are periods where price trades relatively efficiently, and then there are moments where it displaces aggressively in one direction, leaving behind an area that price essentially moved through without much two-sided interaction. That area is what traders commonly refer to as a fair value gap. And understanding fair value gaps is important because they can give us more than just an entry point. They can help us understand how price is delivering from one area of the market to another. What is a fair value gap? A fair value gap is a three-candle formation that represents a form of price inefficiency or imbalance. Let's start with a bullish example. You have your first candle, your displacement candle in the middle, and then your third candle. If the low of the third candle is above the high of the first candle, the space between those two prices is your bullish fair value gap. For a bearish fair value gap, it's the exact opposite. The high of the third candle is below the low of the first candle, leaving an imbalance between those prices. And the reason the middle candle is so important is because it represents the aggressive displacement that created the inefficiency in the first place. So rather than thinking of a fair value gap as simply a gap on the chart, I think it's more useful to think of it as an area created by aggressive order flow and directional displacement. Why do fair value gaps matter? Now here's where fair value gaps get interesting. When you go back through enough charts, you start to notice that these areas have a tendency to influence subsequent price action. Price will often return into a fair value gap, interact with that area, and then continue delivering in the direction of the original displacement. That's not to say every fair value gap is going to hold. It obviously fucking isn't, but the recurring behavior is what makes them useful. You can see this phenomenon over and over again across different markets in different time frames. Price displaces, an imbalance is created, price retraces back into that imbalance, and then under the right conditions, price continues in the original direction. That repeated behavior is what we're interested in. We're not trying to predict that every single fair value gap will work. We're trying to recognize when a fair value gap is occurring within a larger market structure that gives the imbalance significance. Fair value gaps as delivery mechanisms. This is probably the most important way I think about fair value gaps. I don't necessarily look at a fair value gap and think, this is support, I'm buying it. I think, price displaced from here, where is that displacement trying to deliver price? Because markets are constantly moving from one area of liquidity to another, a fair value gap can essentially become the mechanism through which price rebalances and then continues its delivery. For example, imagine price has a clear draw on liquidity above the market. Price begins moving towards that draw and creates a bullish displacement. That displacement leaves behind a fair value gap. If price retraces into that fair value gap and the structure remains intact, the fair value gap can provide an area where price finds support before continuing toward that liquidity. So the fair value gap isn't necessarily the destination, it's part of the path price takes to reach the destination. And that distinction is extremely important. The biggest mistake with fair value gaps. And this brings me to the biggest mistake I see people make with fair value gaps. They treat the fair value gap itself as the strategy. They'll open a chart, mark 20 different gaps, and wait for price to touch one. But a fair value gap doesn't exist in isolation. Context matters. Where is liquidity? What is the higher time frame structure? Where is price currently trading? What is the draw on liquidity? And what caused the displacement that created the fair value gap in the first place? When you start asking those questions, the chart becomes much more logical. You're no longer just trading a rectangle on your screen. You're using the fair value gap to understand how price is moving between meaningful areas of the market. So to summarize, a fair value gap is an imbalance created by aggressive directional displacement. These imbalances can act as areas of support or resistance, and when they occur within the right context, price will often retrace into them before continuing its delivery. And this behavior isn't something you see once or twice. When you study enough charts, you start seeing the same sequence over and over again: displacement, imbalance, retracement, continuation. The key is understanding that the fair value gap isn't the entire trade. It's one piece of the market's delivery process. And once you start looking at fair value gaps that way, rather than simply treating them as buy and sell zones, they become a much more powerful tool for understanding price action. If you want me to break down exactly how I use fair value gaps with liquidity draws and my entry model, subscribe to the channel because that's what we'll get into next. And yeah, thank you guys.